Stuart, thank you very much for that. So the final fund to present this evening is Pantheon International. There's a lot of talk in recent years about the growth of private equity, perhaps at the expense of the public markets. And for many investors, it's quite difficult to get exposure to. Pantheon gives you that exposure. It's a FTSE 250 company, market cap something over £1 billion. More importantly, it's got a track record going back some while and has generated an annualised NAV growth of 11.6% since 1987. And we're very lucky this evening to have Helen Steers present to us. She's a partner and her particular specialities are in PIP and the European primary market.
It's left, right, okay. Well, good evening, everybody, and thank you very much for making it through to sort of the end of the evening. And I promise that I'm the only thing between you and the drinks at the back. I will try not to overrun. And I think I've got to. Am I going the right way? Oh, the other way, right? Okay. Never give a clicker to an engineer because we are technologically challenged. There we go. Right. I do like your pictures, though. I wish I got pictures like that. Am I still going? Right. Okay. Perfect. Great. Right. To turn to private equity. So, in a nutshell, as Keith mentioned, Pantheon International PLC, or PIP, as we call it for short, ticker PIN, is a private equity investment trust. We've been going since 1987. Track record of outperformance over many different investment periods. We're a company of scale, so $1.5 billion in NAV, and managed by Pantheon, which is a specialist private equity investor, been around since 1982. So PIP was really almost right at the beginning of Pantheon's existence. So I've got the performance stats there, and you can go through them at your leisure. But you can see that against the public equity indices, we've done very well over various different time periods. And I'll talk a little bit later on about why private equity can outperform. So who is Pantheon? So apart from being a building in Rome, which you're not allowed to visit at the moment because of the coronavirus, and I think that's my only reference to the virus at the moment, we are a private equity, private asset specialist. We've been going for almost 38 years, almost 40 years now. A global player, and really global right from the very beginning. Head office in London, but with sizable offices in San Francisco, London, and Hong Kong. Importantly, we manage $47 billion. So PIP is actually a very important client for us, but it's not the only client for us. So we've got a number of, in fact, almost over 600 institutional investors, investors that have been with us for a very long period of time. And PIP actually benefits from the fact that Pantheon has such a big platform of investment. So PIP can really piggyback on the expertise that we have of investing in private equity over so many years. Almost 100 investment professionals dotted around our various offices, huge amounts of data. And in private equity, that's really important because there is very little publicly available information on private equity. We collect that data, been doing it for decades, and therefore our databases are probably actually some of the best in the business. So institutional investors have been investing for a very long period of time in private equity because of the outperformance that it provides over public markets. So many institutional investors have quite considerable allocations. It can vary from some of the endowments and foundations in the US that can have 25% in private equity, down to the pension funds who may have in the US sort of 7, 8, 9% allocation. But we actually believe that private equity is suitable for many long-term investors, if not most long-term investors. It has to be long-term because creating value in private equity does take time. The private equity funds are raised. It then takes 4 to 5 years to draw down that capital into the underlying portfolio companies. And then there's a harvest period when those investments are sold and the money is returned to investors. It's actually a self-liquidating asset class. However, if you're not an institutional investor, it can be quite difficult. You've got to lock up your capital for a long period of time. The minimum investments in private equity can actually be quite large. Some of the major buyout funds will not accept you unless you can put in $20 million. So that's, I don't know about you, but I don't have that sort of change in my back pocket. And also, if you want to invest in a broadly diversified set of private equity funds, you need to multiply that a few times over. So you need to have a diversified portfolio. And it's not easy, actually, just getting access to the funds, investing in the funds, monitoring the funds, and actually, importantly, the administration is difficult. So just in the last 12-month period, within PIP, we managed 1,500 separate distributions and hundreds of calls. Now, that's a lot of administration. Now, PIP solves all of this because being organized as it is, as a closed-end company listed on the London Stock Exchange, for the price basically of one share, you basically get all of that in a package. And we think a closed-end company is a great way of investing in private equity because it's a liquid way of managing these illiquid assets. So closed-end funds, as you're aware, don't have to sell underlying assets. Everything is done through sort of buying and selling on the exchange. And in contrast with open-ended structures, which do need redemptions. So governance is also very tight. We have an independent board of directors that holds the manager to account. So turning to the private equity market, why do we think that this is a market that's here to stay and an exciting market? Well, you've probably read quite a lot of analysis over the last few years about the shrinking public market. Now, of course, public markets have been increasing in terms of capitalization, but in terms of the number of opportunities, they've actually been shrinking. So since 2008, the reduction in the number of public companies has been about 3% a year, whereas the increase in the number of private companies has been almost 7% per year. So private equity as an asset class has been expanding. We now have about $4 trillion under management globally in private equity, and that sounds like a large amount of money until you compare that with the combined market capitalization of the FANGs, which I think is also about $4 trillion. So the whole of the private equity asset class is equivalent to those few high-tech companies. We think there's a lot more room to go and growth in private equity, a lot more opportunities being created every day, and we think that a lot of these opportunities are just really exciting. They're in growing growth sectors which are quite difficult to access through public markets. And why do investors like private equity? Well, it's the performance, outperformance over public markets over long periods of time. And what we see here in the chart, two charts here, first of all, on the left-hand side, return by different private market strategies. So the big round blob there is private equity in general. And then you can see it broken down by the sub-asset classes, so by buyout, venture, private debt. And you can see there that, yeah, sorry. Oh, sorry about that. Yes, okay. I did tell you I was technologically challenged. So my first career was an engineer, and you can tell that I've gone on to sort of alternative career. Yeah, my coordination, obviously, I'm a better skier than I am a microphone holder. Apologies for that. So private market risk and return on the left-hand side by sub-asset category. And then importantly, on the right-hand side, this is actually why private equity is quite difficult to invest in and why it takes a specialist investor, because dispersion of returns is actually very large in the different sub-asset classes. It's the largest in venture, which may be what you might expect, but even in buyout, you can see that there's a huge difference there between first and third quartile. So I've talked about the attractions of private equity to investors. It's the returns. But why would a management team in a company want to work with a private equity firm? And this sort of then underpins why we think the asset class has still got a lot of room to grow. Well, many private companies don't actually want to go public. They like the long-term investment horizon. They like the fact that they're not held to quarterly earnings. They like the fact that that actually they can implement their long-term growth plans. They like the fact also there's strong alignment of interest between themselves, the management teams, the private equity manager, and then the ultimate investor at the end of the day, the investors in the funds. They're also not just after capital, they're after expertise. And this goes back to the alignment of interest sort of point, because if they do well with the companies, they make a lot of money. They can make life-changing amounts of money. But in order to do that, they don't just need the capital injection, they need the expertise. And private equity managers these days are not just financial engineers. They come with a lot of expertise. The operational value add, so they'll bring experts in to look at supply chain management, procurement, digitalization of portfolio companies. They'll come with very deep sector expertise as well. So they'll almost behave like a trade buyer in many instances. They can also help a company implement something like a buy and build strategy. So that's where you buy a platform company and then you execute a number of add-ons. And because private equity funds and managers have done this many times before in particular sectors, they're adept at helping company managers do this. And they can also do other things, such as finding top talent and adding people to boards of directors and experts and consultants that can, again, help accelerate the growth of the businesses. So that's why companies like it. We also think that not just the companies like it, but you're also tapping into some really interesting trends in private equity. So these are quite disruptive. So whether it's technology disruption, and I can't go through all of these because of time, but whether it's things like cybersecurity or enterprise software, with everything basically going in the cloud, there's a lot of drivers towards the sorts of companies that private equity is investing in. There's disruption in other areas too, in healthcare. So changing demographics, that's throwing up opportunities. Shifts in consumer behavior. So whether it's e-commerce or whether it's streaming like Spotify, one of our portfolio companies, there's a lot going on that private equity is able to tap into. So if it's so attractive, and if we think that performance has been great and will continue to be good in the future, why does the sector trade at a discount? Well, that's a huge question, which I will try to answer. It's not just Pantheon International that trades at a discount, it's the whole sector. So looking at this, we believe there's a number of different reasons for it. First of all, it is perceived as a complex asset class, difficult to enter, long-term asset class. The information and transparency point, we can actually get all the information that we need from our private equity managers and from the underlying companies. But there is this perception, and often sort of fanned by the media, I think, that private equity is an intransparent, opaque asset class. It's perceived as an expensive asset class, and it is very resource intensive, and private equity managers are not exactly badly paid. However, when you look at the sort of returns that we've been able to make over 30 years, and those are the sorts of returns that the net of fees and costs, and we think will continue in the future. There's also this problem of valuation lags and smoothing of valuations, which sometimes creates a perception problem. And then people have got the memories of the GFC firmly in their minds. How will private equity perform next time round? So at PIP, we try to address these problems, and maybe not taking these in this order, but first of all, education, doing a lot in terms of investor relations, events like this, PR, marketing program. We've just relaunched our website, which I would encourage you all to go and visit. So really trying to get people to understand more about the asset class and about PIP in particular. Secondly, PIP itself has performed over multiple periods, multiple economic cycles over a 30-year period, and has produced these good returns over a number of different economic scenarios. So we believe, in a way, the proof is in the pudding. And PIP is managed in a conservative manner. So conservatively managed balance sheet, very highly diversified, so by geography, by stage, by sector, by manager, underlying company. So we believe that there's a lot there to help give investors confidence, and we're really just trying to get the story out there a little bit more. And finally, last but not least, ESG. So Pantheon has been one of the leaders in implementing ESG throughout the portfolio. It's not managed by a separate team within Pantheon. Every investment professional has to combine ESG into our investment decisions and into our monitoring. And we believe, again, that greater governance will actually result in better returns in the future, and hopefully also will increase the sort of the reputational impact of what we're doing. Now, part of ESG is governance, and PIP, again, has been going for a long time, has a board which has very extensive experience. It's a board which has evolved over time. We've just appointed 2 new directors, Dame Sue Owen and Marianne Seagart. We now have 3 female directors out of 8 as well, so we think we're doing quite well on that front. All the directors own PIP shares, and it's a highly engaged board that gets very involved in areas like our investment strategy and really holding the manager to account in terms of our performance and the way that we report. So finally, in conclusion, private equity is a complex asset class, not easy to access. Institutional investors like it, but it's often proved to be a little bit difficult for other types of investors. We believe that PIP actually makes it easy for investors. It makes the public private, in a sense. And when you look at the sort of NAV growth and share price performance that we've been able to produce over a long period of time, lots of different economic cycles, we believe that it's an investment opportunity that really all investors that have a long-term horizon should really be thinking about. So that's it. I'm very happy to take questions.
So one of the concerns, I think, amongst investors is valuation and how who values the assets and how you can prove that the carrying value of the assets is a proper one.
So that's a great question, and maybe if those didn't hear it at the back, valuation, which I think is a perennial sort of question that people have in private equity. So just to say that all of the funds that we invest in are audited. Okay? Pantheon itself is audited. PIP is audited by EY. The valuations that our managers produce go through a very rigorous process. So they have to sign off on them. Their auditors have to sign off on them. And actually, what we've observed over time is that the managers, if anything, tend to be conservative with the valuations. And the way that we monitor that is we track the ultimate exit value of particular underlying assets versus the last complete sort of holding valuation. So we look back to 12 months before to see where the manager was holding the asset in their valuations. And in the majority of cases, we see uplifts on exit. So in fact, if we look at the last financial period, the average uplift on exits in the PIP portfolio was 34%. So there was actually some additional sort of juice or fat there in the valuations. Yes.
Private equity is accessible to retail investor, for instance, through a VCT, a venture capital trust.
Yeah.
I mean, that benefits, from the tax relief as well as the dividends are also tax-free, etc., etc. I mean, I don't know how to pose the question, but why an investment trust vehicle cannot be enhanced by offering tax relief, blah, 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 and all the rest of it. In other words, run it as a VCT.
Right. I'm not an expert in VCTs, I have to say, but VCTs are usually run by a manager, and it's venture focused. PIP is a very different animal. So PIP is globally diversified, so it invests all over the world. It only invests a small amount in venture. It's about 5% is in venture. The majority actually of the investments are in the buyout sector. I didn't really have a chance to go through the whole sort of underlying sort of pie charts of where PIP invests, but it's more buyout focused. It's importantly though as well, it's diversified by manager. So we have many different managers in the portfolio, which gives you, obviously great diversification, reduces the risk, and it's diversified by underlying investment sector, so by different industry sectors. So it's a very different animal to a VCT. I think you can probably hold both in your portfolio. I'd love for there to be a tax break, but I don't think the government's into tax breaks at the moment.
Sorry, I mean, where are you ranked within the sector of private equity? I mean, in terms of your performance.
So I think we do pretty well. I think the fact of the matter is we've been around for 30 years, so we've got a very long-term performance to give.
A number. Are you third? Are you fourth? Are you at the bottom of the list?
I don't have an answer to the rating there, but 11.5% since inception. Oh, okay. Thanks, Mark. There's a question at the back. Oh, sorry. Take that one there first. Sorry, yes, sir.
Okay, right. Is it me?
Yes, please do. Yeah.
Well, I was actually a very happy shareholder in Electra Private Equity. I've had since the day it's floated off. It had M. Branson, and he's got his grubby figures on it, and wrecked the blooming company. Have you got any large shareholders in, one of these activist investors who are likely to asset strip you, like he did, and flog it all off?
No, I think we're very fortunate. We've got a great, very diversified, well-diversified shareholder base, a number of institutional investors, but we've also got charities, endowments, foundations, high net worth, retail. So to our knowledge, we don't. I mean, we're also constituent of the FTSE 250. We've got index funds in there as well. But at this point, we feel good about the shareholder base. Sorry, yes, at the back.
Hi, you've got 9% of your assets in funds or companies that have a vintage of 2007 or earlier. Is that dead money? And how do you deal with the funds and companies that have run on and on and on and are probably charging fees to do nothing?
That's a great question, actually, because it goes into how we manage our maturity profile, which again I wasn't really able to spend time on. But because of the fact that we don't invest in Pantheon funds, we invest directly into funds, directly into secondary investments, and directly into co-investments, and therefore we're able to really moderate the fund maturity profile. So we try and keep it between 4 and 6 years. 5 years is really kind of the sweet spot, because that's the point at which private equity funds start to really generate a lot of liquidity. So we try and keep it at that level. When the portfolio looks like it's getting a little bit sort of long in the tooth, we can add primaries and we can add co-investments, so recent investments. And we can even think sometimes of selling the older funds if we believe that we won't take too much of a haircut on those funds. If we believe that the portfolio is getting a little bit too young, then we can add older vintages through secondaries. But the important thing is that we keep it in that sweet spot of an average of about 5 years, which is where it is at the moment. In terms of those older funds, 2007 and older, they don't really call much capital anymore. They are still distributing though, because as I showed in the graph, the average private equity fund's got a nominal life of 10 years, but then it's usually got another 2 years worth of extensions, sometimes even another 2 years after that. The average age to liquidation now of a private equity fund, I think, is beyond 13 years. So even though they're getting long in the tooth, they still do distribute some capital, and usually at that point, they're not really charging many fees. But we do look at the maturity profile really actively, and if we think that we can trim the portfolio, we will be a seller as well as a buyer of secondaries. Does that answer the question? Oh, sorry, one more question here.
what do you believe are your strengths, or what gives you the edge compared to your peers and competitors in the same field?
That's a great question. So I think, the fact that we've got great performance over a very long period of time, I think that's a big strength. But I think secondly, the fact that we've managed through so many different cycles. So we've been through the GFC, we've been through the tech boom and bust. We've been through a lot of these different periods, as have many of our managers. So we believe that going into maybe a more uncertain period actually will stand us in very good stead. I think that then I would also say the diversification and the scale are big advantages. The fact that we haven't put all our eggs in one basket, we're well diversified, different regions, different managers, different sectors, different stages, and we're a manager of scale with £1.5 billion of NAV. So, and using Pantheon as our platform as well.